Hey guys, welcome back to the Patti Martin Real Estate Group YouTube channel. My name is Adam Wachtel, and today we are joined by mortgage broker extraordinaire, Mike Slater. How you doing, Mike?
Hey, Adam, thank you, buddy. I appreciate you having me on your show this evening.
Any time, your advice is always appreciated. So we're going to be talking about mortgage rates today, how they're impacting the market, talk a little bit about inflation. But given today's economy and the recent increase, it's tough to see confidence in this market. But I guess we'll lean on you to see kind of where this is going to go in the future. But for right now, the Bank of Canada rate is 4.5%.
Correct.
We haven't seen a rate this high since about 2007.
Once again, also correct.
Yeah.
We've also not seen rates increase at this pace in somewhat of 20 odd years.
Okay.
So I think that's probably one of the biggest triggers that's impacted the market. And I think while we're in BC, we're in the most desirable province. The reality is the market will eventually catch up. And when I say catch up, it's all about the fact that people need the confidence to understand whatever the rate is. You know, like people get used to whatever the norm is. If you think back 20 years, rates were in the mid fives.
Right. Or even if you think back just a couple months ago, let's just say 10 months ago, when rates were like, you were getting 2% mortgages.
Yeah.
And people were eating them up. And now all of a sudden we're at closer to while you're qualifying, closer to 7-8% on mortgages. And it's a sticker shock at first, but then does reality set in?
Yeah, exactly. And this is, just listening to the market trends, listening to the Bank of Canada, listening to their terminology, listening to some of the investment advisors with a number of the bigger banks. It's the same thing. It's people's understanding as to what that actual cost is. The reality is we had rates of 0.5 going back kind of March of 2022. And then the Bank of Canada went on this rapid race, target setter by comparison to the rest of the world, the other big world organizations, in that they were saying rates were going to go up, quarter point, maybe half a point, and then we were going to head into this kind of stationary position. The reality is inflation went from the targeted rate, which is kind of 2%, and I'm not sure it's actually been 2%. It's probably been closer to 3%, but then it was up as high as in the 8.3, 8.6 mid-June last year. And so the reality is the Bank of Canada has two policy issues to be able to reel in inflation. One is pushing up their policy rate or their benchmark rate, which is the rate that they lend the money to the financial institutions, and then either quantitative easing or quantitative tightening. And the reality is we came into COVID and we were printing at a rapid rate. We were trying to put as much money into the economy to keep the economy going, good or bad. The reality is you eventually have to pay the piper. There's no free money forever.
Unfortunately, there's no free money forever. So essentially right now we're sitting in a place where the Bank of Canada has a rate of 4.5%.
Right.
But what we're seeing is that mortgage rates are even higher.
Right.
So give us a little bit of so let's just backpedal a little bit, but give me a little bit of understanding on why that is.
Okay. So in terms of bank rate, that's the bank BOC's set rate at their lending criteria to the financial institutions. The variable rate is directly linked to the BOC's rate. It's typically a 200-point spread, meaning typically about 2% difference between the bank's posted rate of 4.5 and the current rates. Well, it's actually even higher. I'm not sure if that's maybe even a little bit of greed from the financial institutions, because when money was cheap, it was easy to get it out the door. The reality is now it's a little bit harder to get it out of the door. So we think that it's obviously a little bit more expensive and they price it accordingly. So variable rates directly linked to the Bank of Canada, whereas the fixed rates, they're also a little bit higher and are tapering off a little bit, are linked directly to the 5-year bond rate.
I mean, to me, this seems very correlated, but how does this affect mortgage affordability? Well, keep in mind, we still have the stress test, right?
Well, yeah, exactly, which instituted in 2016. So yes, So there's two things. Like when they set out that stress test 2016, they said it was the posted rate plus 2%, and or whatever your rate at the bank is, whichever.
Sorry, what? I just want to backtrack again. The posted rate being
The posted rate meaning your mortgage rate. So if the rates then were 3.29, they were still saying was 3.29 plus 2%. If it exceeded 5.25, which was the stress test, then that's the rate you use. Otherwise, you use the stress test being the higher. So when rates were down at 1.5, we were still qualifying clients at 5.25%, meaning that the bank was saying clients should be able to weather the storm getting up to a range of 5.25. Well, that's not the real reality. As you and I know, the fixed rates are somewhere in the mid to upper fives, and they're tapering off a little bit. You're now starting to get back to sort of the early fives, in some institutions a little below five, in the insured environment versus the regular mortgage environment.
So would you say that with the stress tests today, you're qualifying closer to 7 or even 8%?
Exactly. Because it's either 5.25 or your contract rate plus 2, whichever is the higher. Correct.
Okay.
And so that's the reason the market is tapered off, is because it was 5.25, and then it was 5.75, and then it was 6, and then all of a sudden it was 6. And this was all within a few months. It wasn't like we had a year or 2 years to digest increases.
So where do you see this going in the future? And I know there's rumors that the stress test is going to be increased even further to help protect consumers against more inflation. Justified or not, where is this going?
Well, we don't exactly know. The financial services have put it out for review. The discussion is they wanted to protect the environment, so protect the lender as much as they could, because at the end of the day, Bank of Canada is not interested in forcing people into a financial crunch. At this moment in time, they don't really have an option, because we need to slow inflation. If we don't, the cost of living, it's exorbitant today, but a year from now with even 6.1%, the rate of inflation, cost of living will just be exorbitant. So the reality is they're stressing the market by pushing the rates up. Down the road, there will be a point where there is a pivot and a decline, but the market needs to turn, right? And the only way you do that is potentially there could be a recession or a soft landing. And at that point in time, the rates will kind of go into a holding pattern. And then the only way out of it, two things. You can either stimulate the market by printing more money, which isn't going to happen, or lower the rates. So
what do you as a mortgage broker see kind of happening first? Do you see rates coming down slowly and then the market kind of picking up? Or do you think it's going to be more inventory based or a recession based way to make the market kind of increase and pick up again?
So it's a really interesting question. The reality is you listen to the financial analysts with inside of the institutions, and they all said, yes, we could probably see a cut in rates early in the year. But the reality is I don't see that happening. I think we'll be more like we're getting to that pivot point where the bank stops. Right now, they said they were slowing down January at the last call, at the last quarter point increase. And there were going to be a pivot to see where the market is at, give it probably the next announcement, which is early March. At that point, they could still increase another quarter point, potentially maybe even half a point. But it's all about the data. And the data lags kind of 6 to 8 months behind what happens with rates. So while it seems extreme that we've pushed the rates up 4%-ish overall in terms of the bank's BOC rate, the reality is they haven't even given the market a time to catch up and feel that reality. And people will start to feel the reality right now. So and I'm going to just say that I think they would probably be in a holding pattern for a period of kind of 8 to 10 months. And at that point, kind of the last quarter of this year, my expectation, and kind of just listening to what's out there, is that's when the rates will start to taper. And I don't think we're going to get a massive drop, but we could see a point and a half overall decline. And so we'd be back in the fours.
That will definitely show confidence in the market. This was an interesting excerpt from an article I read from one of the Bank of Canada's posts, is that CPI it was 8.1 in June 2022, and today it's about 6.3. So
Mm.
that's confidence inspiring. I hope to get us back down to that 2-3% inflation rate, and then hopefully we can see interest rates with a softer landing later in the year, so that the economy can just keep slowly going forward. Talking about moving forward, I mean, there's still uncertainty. Let's be honest. Like, we don't know what's going to happen. I don't think anybody does until we get that data and we move it along. How do you advise clients who are getting new mortgages? How do you advise them today? What do you recommend?
So are we leaning along the lines of whether we go fixed or variable? It's not about
Yeah,
actually qualifying the client. So it's all about a risk analysis with the client and the client's overall financial profile. So people have a risk tolerance. They either get involved in the stock market or they don't get involved in the stock market. They prefer to put their money into the bond market because they feel more secure. They guaranteed a rate of return of, say, it's 5%, and they don't have to sweat the small stuff. So in terms of a variable versus fixed, it is about the client profile, number one. The understanding is that statistically, you can always look that the variable over the last 20, 25 years has outperformed the fixed rate environment
right,
until now. When COVID came along and, supply and demand issues, the war, all of those factors which are not in the textbooks. There's no data to go back and say, oh, because of this, this is the outcome, right? So the reality is clients will go into a fixed rate environment because it's a stable environment, whereas a
right.
variable rate environment, you have to wait for the other forces and the data to help drive the Bank of Canada to reduce their benchmark rate. And so the reason why a big chunk of the mortgages went into the variable rate environment in this last little while is because people were able to afford more buying power. They're qualifying at 5.25% with a rate of 1.5 to 2.5% versus the fixed rate environment at the time, which was 3.79. So,
Yeah, when they're giving you cheap money, you take it.
yeah, of course. And the reality is rates of 5% are not unreasonable. It's just the last 15 years being in the industry, you understand that it's not the norm. It's always been cheap money, and people understand it always to be cheap money. So I think it's about conditioning the public. The reality is it's a great city, great environment, supply and demand issues, which is one of the targets I don't believe will ever meet. So stability in rates and inventory coming back into the market, immigration, population drive, the market
So,
eventually returns.
so just to take another little pivot on that same type of question, if somebody is refinancing their mortgage, like they're coming up to their 5-year term, aside from knowing someone's like specific profile, how do you think what would you choose? Fixed or variable? Would you go fixed at 5-6% for 12, 18 months and try to renegotiate, go variable and just ride the wave? Like, there's no right answer here, and this isn't a one solution fits all. We put that caveat in there.
Yeah.
But what would you do? I mean, you see the numbers, you see the data, you know the policies. What would you do?
Right. Yeah. And exactly. Once again, it's looking at the information, right? It's looking at the data. And my mindset is that I think that a variable rate environment will come out on top, but I think the risk tolerance in the immediate short term is pivotable. So I think a fixed rate for a 2 or 3 year and then the ability to switch back into a variable rate environment would probably be the right solution. If you're looking at mortgages over the last couple of years, it's also about the discounts that the banks were offering. They were offering up to 1.5%, which is unheard of in terms of discounts, down to the variable rate discount from the institutions today are kind of 20 basis points, maybe 30 basis points. So it's not an incredibly great discount, and therefore it's hard to justify that you're still kind of in the sixes in a variable rate environment, and you could get 5.49, 5.39 in a fixture for a 2-year or 3-year term right out the way. I think that would be the solution I would be offering up to the clients right now.
So you made an interesting comment there that when the rates were cheap, banks were giving out fairly hefty discounts, like a full 1% discount.
Mhm.
And I've looked at some of my clients, and they're getting prime minus 1%. And
Right.
at the time, their mortgages were about 1.3. So, what do you think leads the bank to go, here's cheap money, and we're going to give you even cheaper money? So, here's your rate of 2%, but we're going to give you whatever the prime is, minus that 1%. So now you're at like 1.25, 1.5% as your
Right.
mortgage rate. Versus today, when right now you need that discount because 6% on $1 million mortgage is drastically unaffordable for the majority of the public, but that extra 1% savings could be substantial. So why are they giving it out when money's already cheap and not right now?
The reality is you also have to look what the bank was stating. The BOC was stating back in January of last year, February of last year, rates will be continuously low until probably 2023, 2024 and beyond. Money will remain cheap because no one really expected inflation to take off the way it did. The war, supply and demand issues, just the reality of people wanting to get back to living. So the motivation was the banks were trying to, in my opinion, pad their books because the more asset under management gives them the ability to borrow more money from the Bank of Canada. So it's like this vicious cycle. They're in the business to make money. They're not your friends. They only give you those discounts to incentivize you to come their way, right? So, and I think those discounts will come back. I mean, some of the institutions are already offering 50 basis points, 75 basis point discount on the variable rate with the intention of trying to win back some of that business. So I think those discounts will increase as the rates taper off a little bit, for sure. But it's about where can we best situate the money that we get? Like,
Right. Right. So, Mike, as we kind of taper off here, are there any more comments, stories that you want to share on your side of the world with mortgages?
well, the reality is people have to get accustomed to what the rates are. Like, that's the reality of life. Cheap money for the last 15 years is ludicrous. I mean, to think that the asset increased in value. If you're looking 20 years ago, the average house in Richmond, for example, was kind of in that mid 300, maybe late 300s, and you were at a 5% rate. And then fast forwarding 20 years later, that same real estate asset is now 1.1, 1.2 million. I mean, I'm not a realtor, but I'm just basing it on my own legendary in terms of my first purchase in Canada versus where I am at today.
Right.
And so that same house, the value increased fourfold, not really, probably threefold, and the rates went up, marginally in that 15-year span. And so it was still kind of affordable until you hit the reality of the rates at 5%, as you mentioned earlier, a $1.1, $1.5 million mortgage. People aren't accustomed. People,
Yeah, put some stress on you. Yeah.
well, sure. And people, even though you were saying, yes, you were qualified at 5.25%, and people are qualified at 5.25% with the stress, but the reality is they don't factor that into their budget. They factor the mortgage payment and maybe slightly higher, just marginally, because, cost of living, cost of gas, cost of a car payment, all of those things. And so I don't think they fully digest the implications. And I think that's probably one of the reasons I think that the rates will start to taper towards the end of the year.
Well, let's hope it happens sooner rather than later.
Likewise.
All right. I think that's a good amount of information for everybody to digest and go home and ponder on how to proceed with their mortgages going forward.
Right.
If you want to get in touch with Mike, I'll make sure that your information is in the link below. And if you want to get in touch with me or anybody else from the Patti Martin team, click the link in the description. We'd love to hear from you.
Great. Adam, thanks very much, buddy. It's greatly appreciated.
Thanks, Mike.